Hello, all you lovely people out there. How is everyone doing? I'm Kate Hill and I am here as always to give you the best content on property, along with fabulous strategies, hints and tips. Today, stay tuned for all your latest property news. Interest rates will probably rise again in the short term, but are then tipped to fall. In May, the RBA increased interest rates by 0.25%. This was followed by two larger interest rates in June and July, and then again in August, which now takes the Australian cash rate to 1.85%. This increase in interest rates has had an immediate and harmful effect on borrowers. Tim Lawless from CoreLogic has said that with household debt at record highs and most of that debt held in housing assets, the household sector is highly sensitive to the rising cost of debt. However, sizable repayment buffers, which the RBA recently estimated to be around 21 months for variable mortgage rate borrowers, should also help to cushion distress across the mortgage sector. Now, some bank economists have recently revised their estimates of where the cash rate will end up in 2023 from 2.5% to over 3% due to higher than expected inflation figures topping over 7%. With a more flexible and adaptable economy, we may find supply chain issues resolving sooner and absorbing the inflationary pressures. CBA, ANZ and Westpac economists are now tipping that we will see interest rate cuts sometime in 2023 or even early 24 to stimulate the economy again after the sudden slowdown in economic growth. With household debt much more sensitive to interest rate rises, the adjustment really needs only to be marginal to have that more widespread impact on consumer behaviour. So is now a good time to buy property? The dilemma for property buyers is that rising interest rates significantly limit your borrowing capacity. A 1% increase in those interest rates can mean a 10% reduction in your borrowing capacity. Banks are still keen to lend though, that is their business. And more investors are coming back into the market as rental yields have been and will continue to rise. If you wait too long to get your finance approved, you will find your borrowing capacity is actually too low and restricted to get into a lot of the property markets. You are generally better off to take advantage of the borrowing capacity that you can attain right now and be sure that you can build in comfortable serviceability around the interest rate rises, and the banks do always assess your capacity with extra buffers in place. Property listings are still 26% below their long-term average, and sellers will find it harder to achieve their price expectations in that coming spring market in Australia when more properties are listed. Psychologically, it is hard to buy property when doing so seems unpopular and that herd mentality is running scared. The media will tell you what you believe, and the media is shouting, watch out. You might have friends saying that be careful and don't overcommit. Work colleagues are worried about mortgage interest rates rising. While it may feel counterintuitive to buy in a correcting market, there are lots of really good reasons why this is the best time to buy. And history has told us this over and over again. Be brave when others are fearful, and be fearful when others are being too brave. Right now, in some markets, there is less competition. Consumer sentiment is extremely low. This is the ideal time for us to take advantage when you're negotiating and lock in a better price. Prices in correcting markets will stabilize. Waiting too long to pick the exact point of the market is tough. It's extremely difficult. Once migration really ramps up again, this will worsen the rental crisis. It's great for landlords to increase the rent, but much tougher for tenants trying to contain cost of housing. And then these people will settle in Australia and they will purchase property, creating much of that demand again, potentially in a decreasing interest rate environment. Lastly, there is currently literally zero risk of oversupply in many markets, with construction costs rising so rapidly, the volume of building approvals has trended down substantially. Now, this will mean we are now entering the next cycle of constant undersupply in many property markets, which will support prices. Quality property in the right locations is still selling for pretty good prices. These high quality properties in the right locations will hold their value far better than obviously lower grade properties located in inferior positions and in inferior locations. So my message to you out there is that the next few months really will provide some of the best buying opportunities that we have seen for a couple of years now. While sentiment remains very low, I do recommend buying now and keeping a long-term perspective. Keeping on with that same theme, I am going to keep hammering this point home. The number of properties for rent dropped 4.5% to a record low in the past 4 weeks, according to new data from SQM Research. Nationally, there are now only 55,124 properties available for rent. Sydney recorded the biggest drop in listings of 5.7% to just over 16,000, which is the lowest level in 5 years, while Melbourne listings fell by 3.6% to 14,500, which is a 3-year low. SQM Managing Director says that the shrinking pool of available properties, coupled with increasing demand from returning international students, has led to this sharp drop in vacancy rates in CBD markets. CBD vacancy rates soared during COVID, but Sydney's is now just 3.5%, Melbourne 2%, Brisbane 2.2%. With the falls in CBD rental vacancy rates to well below average, we have evidence that the rise in overseas arrivals is starting to put that additional demand pressure in certain pockets of that rental market. We will wait to see if the increased immigration demand creates pressure elsewhere. While the return of overseas workers and international students has put that pressure on our capital city rental market, some regional markets are easing a little bit. SQM research data shows that vacancies increased a little in areas such as Wollongong and the Central Coast during July. Despite the easing in those locations, the national vacancy rate remained steady at 1% in July. It's very, very low. SQM says that rents in capital cities are also on the rise, up 1.2% over the 30 days to August 12th, resulting in a 17.4% increase in the past 12 months. Rents for houses in capital cities increased just over 15% over the same period, while unit rents were up 16%. But average rents decreased slightly in Hobart, Darwin and Canberra in the past month. The rental market, by and large, remains very, very tight. Now, analysts may be predicting property price drops, but new data shows only 1.5% of Australian capital city suburbs have recorded a price decline in the past 12 months. The analysis by real estate economists Nerida Conisbee shows that Melbourne and Sydney have the most suburbs with price drops. Interest rates are on the move, prices are slowing, but at the suburb level, we really are yet to see much evidence of widespread declines in prices, she says. Her analysis shows it is the wealthiest suburbs that have been affected most by declining property prices. In Sydney, a higher proportion of very expensive suburbs, those with a $3 million plus median price, and more affordable, less than $1 million median, experience price drops. In Melbourne and Adelaide, a higher proportion of expensive suburbs recorded drops in prices. Elsewhere around Australia, it is the cheaper suburbs, so those under $1 million, perhaps reflecting that first home buyer pullback, as well as fewer investors. Higher price point suburbs are either holding steady or alternatively still recording increases. Now, we will keep you posted on all things property from around Australia as our year progresses. Don't forget to hit the subscribe button and give me a little like if you are enjoying the free content. And I will see you all again really soon. Bye.